Welcome to Yahoo Finance Live. I'm Julie Hyman along with Josh Lipton. We're here at the New York Stock Exchange, and here are your top stories to watch as of 3 p.m. Israel launching an offensive in Gaza after Hamas's surprise assault over the weekend. The death toll of the conflict rising to over 1,300 since it began on Saturday. That includes at least 9 U.S. citizens, according to the U.S. State Department.
And investors shaking off early declines on the conflict, driven by comments from Dallas Fed President Lori Logan and Fed Vice Chair Philip Jefferson. The big moves today are in the energy market. Crude prices jumping more than 4% on the day. As of now, no major production disruptions are expected. Natural gas also rising, especially in Europe. And Chevron shutting down one of its nat gas platforms in the Mediterranean will get you up to speed on all the market reaction in the wake of the escalating attacks.
But first, let's get you caught up on the markets and where we're seeing them stand right now. All three major averages are in the green, but just looking at the board here doesn't really give you the full story. Because we have had quite a range, a trading range throughout the day. The Dow has fallen by as much as 154 points earlier in the session, risen as much as 224. Now it's hovering to the upside. Similarly with the S&P and the Nasdaq, we've been to the downside today before seeing this recovery.
Yeah, so interesting market action today, Julie, in the sense that stocks were under pressure early. And now I'm looking at my screen, though, and we just see green across the screen here, all three major averages ticking up. And I wonder if, and listen, like any day, there's multiple cross currents, but I wonder if some of this is the market saying, listen, as horrible as the headlines are, the market may be indicating in part here, we think it stays limited, we think it stays contained. We don't know that, of course. I mean, it could broaden out, pull in other actors, but I'm looking at the SPX, the S&P 500, we're up 0.7% now.
Yeah, I've seen a lot of analysis over the course of the day of people trying to put this in historical context, which is sort of difficult to do, right? Because there's no direct comparable situation. Even if you look at the situation with Russia and Ukraine, for example, there were other repercussions there, sanctions, et cetera. So I've seen a lot of people trying to grapple with that. But at the same time, there is other news flow here to watch today. You have all of the oil markets on the one hand, but you also have Fed speak that you alluded to from Lori Logan and from Jefferson today, and both of them seeming to indicate that the Fed is going to be a little bit more cautious at the very least with raising rates, and really thinking about one of the themes that we were talking about last week, which is the rise in rates that we have seen already could act as a curb on further inflation. And that seems to be something that the Fed is cognizant of. It's also something that the market's cognizant of. I was just looking at CME Fed Watch. We should mention bond markets are closed today, but the sort of futures are open, the TLT is still trading, and so too are those options trades on Fed funds futures. And that is showing a lower probability now of a rate increase at the November meeting.
Yeah, you do watch oil prices too, though, and rising. And listen, it's one day's move, and we're still far below where we were. But you wonder how that plays into Fed thinking as well, looking at that next Fed meeting, to the extent that it stokes inflation. It was also interesting reading through some of the commentary. You see some of the names that are really moving today. The oil names, the defense names. If you were looking to hedge that conflict, those are the kind of names you would move into. And some folks are saying, regardless, some of those sectors were already looking relatively attractive.
Right. So that's driving some of it today as well. We are, by the way, going to dig further into the oil story a little bit later in the show. So stay tuned for that to try to get our heads around how to put this, again, in historical context.
All right, Jared Blickery is on the floor here with us at the New York Stock Exchange with a look at some of the biggest movers on the day. Jared, over to you.
Thank you, Joshua. To your point, we have clawed back some major losses from the morning in all 10 sectors, and not 11 sectors are green. I'm looking at the Wi-Fi Interactive. Only Staples, a defensive sector, is in the red, but energy has been in the lead since the early going. That's up 3.5%. WTI crude oil and Brent, those are both up more than 4%. I'll leave that oil analysis for later in the show. Also seeing industrials, that's where you see some defense stocks, not defensive, but defense stocks like Lockheed Martin coming in. I'm going to check out that board in a second. But all in all, you know, it's easy to forget that Friday was also a very similar day, very different circumstances, but we began in the red, and by the end of the day, we had clawed back those losses. So a market that keeps on going up when bearish headlines persist. Well, that's a bull market. All right, now let's get into some boards here. Let's check out energy, the leading sector. Not surprisingly, on the Wi-Fi Interactive, we are seeing a lot of green. Exxon, Chevron, each up more than 3%. So is BP, so the majors flying high. Occidental Petroleum here up 4.5%. Schlumberger up about almost 5% there. But a market difference here when we're looking at all the light green and the red in the banking sector here. What I want to do, though, is skip down into the defense area where we have Lockheed Martin. That's up 8.5%. You'll note from this year-to-date chart that it has recaptured a lot of these losses that we had in September, but a lot of these defense stocks look similar, and I wouldn't be surprised if there's a little bit of short covering because a lot of these stocks have sold off precipitously over the last month, 2 months. Here's a similar look at Northrop Grumman, off of the lows here thanks to the price action today, but it had been depressed prior to the latest headlines. And when we think about Israeli stocks, it's kind of like a Silicon Valley over there in a lot of respects. There's a huge startup community. All of these stocks are Israeli-based, but they are listed on U.S. exchanges here, either the Nasdaq or the New York Stock Exchange. And you can see there's just a huge red negative bias here. A couple like DRS, that's up about 6%. But most of these companies are either biotech or they're software companies, so actual tech, I guess you could say. Ello is the worst off, down 16% today. That is an alternative energy company. So all of these companies have their own individual story, but I think the uniting theme here today is that they are just under pressure because of the exigent circumstances. I want to close by looking at the currency market. This is the US dollar versus global currencies. What I like about this picture is it's not all green. That means that if it were, that means the US dollar would be catching that safe haven bid, and that could spell all kinds of nasty things for risk markets, but it's kind of risk on today. In the upper left, ILS, that's Israeli shekel. That is losing some steam versus US dollar, not surprisingly, because the Israeli central bank there is coming out with all kinds of stimulus measures to protect their bond market. But nevertheless, all in all, it could be a lot worse today, especially considering the largely bullish action that we've seen in US stocks.
Jared, thank you so much. Comprehensive look there, what's going on in equities today and beyond, for that matter, to currencies. Thanks so much. Well, as we've been hearing, the implications of the conflict in Israel and Gaza has global ramifications, and the story is changing quickly. Let's get caught up on how the violence has unfolded. On Saturday, Hamas, which is designated as a terrorist group by the United States, carried out a shock attack on Israel on the ground and by air. An estimated 700 people were killed, thousands injured. Hamas claiming to have taken at least 100 people hostage, and the U.S. condemned the assault. The following day, war was officially declared by Israel, and they retaliated with air raids of their own, in which at least 500 Palestinians were killed. President Biden pledged additional support for the Israel Defense Forces, and Defense Secretary Lloyd Austin announcing the Navy was sending its most advanced air carrier to assist Israel. This morning, Israel's military said it had retaken control of all communities around Gaza following what was called a complete siege that included cutting off all food, fuel, water, and electricity to the area. And even now, we are continuing to track many of the headlines. Joining us now, John Alterman, Director of the Middle East Program at the Center for Strategic and International Studies. John, thank you so much for being here. We obviously need help putting all of this in perspective and in context. As you watch the offense on the ground, how best to do that? How best to put this latest escalation in context and help us figure out what might happen next?
Well, first thing is to note that this is unprecedented. Israelis had convinced themselves that Hamas didn't really matter that much anymore. Israeli security folks had a saying that it's like mowing the grass. Every few years you have to go in, Hamas acts up, you destroy things in Gaza, you teach them a lesson, and you can go back to it. I think Hamas succeeded far beyond their ambitions on Saturday. Large numbers of Israelis killed, large numbers, as you say, of Israelis taken hostage. How that affects what Israel will do in terms of attacking Gaza, attacking Hamas in Gaza, what the end game for Israel will be, what kinds of political outcomes it's going to want. We don't know what that is, but we have moved away from this mowing the grass. There is going to be certainly an absolutely devastating military assault. It will be from the air. Some part of it will be on the ground, occupying part of Gaza. But what happens after 2 or 3 weeks of that, after we see images of human suffering in Gaza, after the world says, so where are we really trying to go there? To me, that's where we're going to have a whole new set of challenges. For it's easier to start a war. How do you end this war, and what are you trying to do, and how to ensure that this time you're not just laying the seeds for the next confrontation?
I guess, John, the end game, it seems to me, and correct me if I'm wrong, has kind of changed here. When I listen to Israeli leaders, as you noted, for many years they've been content with kind of just containing Hamas. But when I listen to them now, the narrative, the language has shifted. They don't seem to be talking about containing Hamas. They want to destroy Hamas. If that's the objective, what do you think the next days and weeks look like in Gaza? And if they were successful, John, what would come after Hamas?
Well, I don't know exactly how you destroy Hamas, because you have 2 million Palestinians in Gaza. They feel totally disenfranchised. They feel that Hamas, sometimes provides them with jobs, provides them with protection, provides them with an outlet for the frustration over the situation they live in. A lot of Palestinians blame Israelis. They don't blame Hamas. So you can sort of try to destroy the organization, but you still have a large population of very angry Palestinians who say, we don't want to live under Israeli occupation anymore. And how Israelis figure out a way to do that? Is there some sort of interim government? Is there another government? Is there a way that other Arab states can play a useful role? Egypt has often played a role in Gaza, but I think envisioning what a future would look like where you can marginalize not only Hamas, but the many Palestinians who sympathize with Hamas because they feel that Hamas is their only defense against Israeli oppression. How do you find a solution to that without a long-term occupation where people are continuing to take pot shots at Israeli soldiers, where Israeli soldiers don't want to serve in Gaza? This is a harder problem. Israel occupied Gaza. It withdrew from Gaza for a reason. It hasn't gone into Gaza in a long-term way for a reason. And I think we need to find out, and I'm not sure how it's going to happen yet, but we need to find some sort of political solution. The military tasks are relatively easier than figuring out how to build the political tasks and building a consensus both in the Israeli government, but also among Palestinians, that this is a way forward.
Well, John, what I've been trying to figure out, you talk about reasons on the Israeli side. I've been trying to figure out the possible strategic reason for for the action by Hamas over the weekend. In other words, they had to have known that Israel would retaliate. So what's the end game there?
So I think first they were more successful than anticipated being. I don't think they anticipated being able to take 100 hostages. I don't think they anticipated they were going to kill 600 Israelis or more. I think that to some extent they're going to be a victim of their own success. They've raised the threshold of what Israelis will demand. But the clear Hamas insistence was, we will demonstrate to Israel that you can't integrate yourself into the region. You can't have peaceful, comfortable lives if you're going to leave us in this open air jail. You will have to deal with us and our demands. What that is going to look like on an acceptable level for Hamas, on an acceptable level for Israelis, what role other people can play, I don't know. The other piece, and we haven't talked about it at all, but the other piece is Israel is currently fighting a one-front war. There's a non-trivial possibility, I think not a likelihood, a non-trivial possibility, Israel could be fighting a three-front war, with a war from Hezbollah in the north, a war with Palestinians in the West Bank, and a war with Gaza. And one of the things Israel has to do is to somehow deter these other forces, as well as show a sign that there's a way to reach some sort of accommodation so Israel can focus on fighting a one-front war for the foreseeable future.
And John, we know, of course, that Iran is a key supporter of Hamas financially, militarily. How do you think this perhaps changes the U.S. relationship with Iran going forward?
I'm not sure it actually teaches us anything. Iran is a state that is economically constrained. I think they are internally divided. Their competence isn't nearly as great as they'd like people to believe. Iran has been a strategic supporter of Hamas. It's certainly given Hamas weapons and money in the past, but I don't think Iran is pulling the strings here. I think, in fact, they're just exulting that everybody thinks they're behind it. Everybody thinks that they're more powerful than they are, and that must be a good day for Iran. To me, Iran is going to be a strategic challenge for the United States to manage both its efforts to promote instability in the Middle East and its proliferation efforts. It's going to be a long-term problem for the United States. I don't think this actually gives us a lot of tools or a lot of reason to treat Iran differently, because I haven't learned anything about Iran in the last 3 days.
And John, similarly, I think the big question when it comes to markets is, will there be some kind of bigger spillover that will create, either problems for the oil market or problems for the global economy, et cetera? It sounds like at this juncture, from what you're saying, you don't see that to be the case.
We don't see it yet. I think we're walking on a tight line, and it certainly could tip over into that. Everything we've seen so far from Hezbollah is they have been relatively careful. They have sort of had station identification strikes with Israel, but they haven't really sought to amp things up. Hezbollah has a genuine rocket and missile threat in the south of Lebanon, unlike Gaza, which has been contained by both the Egyptians and the Israelis. They have a relatively open border with Syria that Iran can ship rockets and missiles into. So if there were a war with Lebanon, it would be harder for Israel. But don't forget, Lebanon is in complete financial meltdown. Israel would pound the south of Lebanon into rubble. It's not clear to me that Hezbollah I don't think Hezbollah knew this was coming because of Hamas's operational security. They couldn't have tipped too many people off. This comes out of the blue. Is now the time that Hezbollah really wants to press things to the limit? There's, I think, a very real possibility that Hezbollah looks at this conflict and says, we could lose it all. Lebanese could turn on us, and we could lose the position we have in Lebanon. Let's just act like we're supportive, but don't incur the wrath of the Israelis, because we're not prepared in the current context and in the current Lebanese situation to take that on. That's my instinct, but a lot of things could happen. Images could come out through social media that inflame people. I could imagine a lot of things that would tip us over the edge, but everything I see, Hezbollah's instinct is to keep its powder dry right now.
It's a dynamic situation. We're going to keep monitoring it. John Alterman from the Center for Strategic and International Studies. John, thank you so much.
Pleasure. Thank you.
We're just getting started here on Yahoo Finance Live. Coming up, the ramifications behind the rising popularity of Ozempic and other weight loss drugs. We'll talk to one analyst who argues the medications will be a headwind to the packaged food industry. And Sam Bankman-Fried's ex-girlfriend, Caroline Ellison, will take the stand Tuesday in Bankman-Fried's fraud trial. We'll get a preview of her possible testimony. And RFK Jr. running as an independent. We're going to break down the change-up and what it could mean for Joe Biden.
auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead, right here on Yahoo Finance.
Investors are weighing the market implications of the war between Israel and Hamas. Market reaction has been muted so far, with investors perhaps betting that this conflict will remain contained. We're going to break down some of the short and long-term ramifications with Rob Williams, Sage Advisory Managing Partner and Chief Investment Strategist. So, Rob, let me start there with these headlines out of the Middle East. Investors now dealing with a new and very real geopolitical risk. I'm just interested, Rob, as a professional investor, as a strategist, how you're thinking about that risk and what you're telling clients this morning.
Yeah, and it's not what we needed, more risk to the market. We've been in a correction on risk assets, but it's really been driven by rates, supposedly on the back of a stronger economy. And I think now it has a danger of transitioning from a rate-related correction into a flight to quality correction, right? A real risk off. Now, it doesn't look like it today, but again, that's very temporary. Bond market's closed. If you look at the bond ETFs with our trading, like a TLT, like a long bond ETF, that's up about 2%. So it implies that rates would be down. And I don't think rates would be down because of a couple Fed comments today. I think they'd be down because risks in this market are growing. Right now, we've got not one war, but two wars to talk about. We've got strikes. We've got budget and congressional dysfunction. So I think the risks are growing in the market. So I wouldn't get sucked into a temporary, this is not going to be too bad. Our view is you should be pretty defensive and think about why rates are going down. Not, and the market gets very caught up in a couple comments from the Fed, but you have to kind of diagnose, why they're going on and how's the risk complexion of the market really changing here.
Is it surprising to you, though, Rob, that in the face of now a new war, notwithstanding the Fed comments, even that the market, that's equities that is, have been so resilient today?
Yeah, equity resilience has surprised me in a lot of ways over the last year or so. It shows you how keyed in they are on the Fed, because futures and early market action, I mean, you guys would know better, but the equity markets were looking a little wobbly, and then they caught a little bit on Fed comments. But to me, the Fed's just delivering their same message. They're data dependent. The data's been okay, so that's kept this idea of a hike on the table, which has kind of rattled the equity market. But now they're starting to ask a question, the Fed, and investors should ask this question: is are rates higher? Especially this latest move, it's really been the long end of the curve. Are rates higher due to economic strength that's going to continue to go and require more hikes? Or is the curve getting steeper because investors are starting to demand term premium? I'm starting to demand some extra compensation to go out on the curve because risks are rising overall. And if that's the case, then no hikes are necessary. They can be patient. And I think financial conditioning, they're acknowledging they are tighter. And that lag effect's going to hit the real economy. And so that's fine. The Fed can use their forward guidance. They can use QT. They don't need to hike rates. But I think things are getting riskier, and the defensive posture is better, regardless of how they're handling it today.
Well, they do seem to be acknowledging what you're talking about. At least the speeches that we heard today seem to gesture more at that term premium impetus rather than sort of the fundamentals of the economy changing. So what does that mean for an investment perspective then, in terms of what one should do with bonds right now, for example?
Yeah, I mean, thinking about an asset allocation, I would start to think you were just given higher rates and a steeper curve. So if you were thinking about extending duration or adding to your bond portfolio, it just got even more attractive. So for one thing, the macro geopolitical environment over the medium term suggests actually having bonds over stocks. This is not 2022. We're getting significant carry in fixed income, right? You're getting almost 0.5% in core fixed income a month. You weren't getting that in a year. About a year and a half ago, it took a whole year to get that. So one thing you can do is start thinking about that. And that's why we're talking about the term premium more, because to get people out of cash into duration, you need some compensation. And that's why the curve's steepening. They're kind of giving you that signal. So I think extending duration, overweighting bonds, but being careful on the credit side, because all the same things that I've been talking about that may plague the equity market could plague credit down the road.
And Rob, as you encourage this more defensive posture in the equity market, what does that mean exactly, Rob? Are there certain sectors you like? Is it staples? Is it utilities? And can those work even with these rates rising like they are?
Yeah, some of the defensive weren't as defensive as they usually are because it was a rate-driven correction. If it turns it into a macro risk or a slowdown correction, those will work even more. Some of the utilities and the REITs, these bond proxies got kind of beat up, so they didn't shield you. So things like healthcare and staples did better and should do better. And then being mindful of the U.S. market's very concentrated in a handful of names that's driving up valuation. So looking towards being a little more equally weighted in your sector allocation could be a smart thing right now. And then any way you can drive yield in your equity portfolio provides you cushion. If you don't think even if you think the equity markets aren't going down, they're going to go sideways, not a bad time to drive some yield through your equity portfolio without actually getting out of equities and pushing up your fixed income. And then looking outside the U.S., U.S. has got the best fundamental picture still, even with its problems, so we don't like core Europe, but there's some places like Japan and the UK that are discounted a good deal from the U.S. that might make sense for diversification.
Rob, lots of good ideas in there. Rob Williams, thanks for your time today. Appreciate it.
Appreciate it. Thank you.
Let's get to some movers to watch right now. First up, we've got Disney shares. They're higher by more than 2%. Nelson Peltz has reignited a potential proxy battle as he pushes for control of more board seats. That's according to sources first reported by the Wall Street Journal. The co-founder of the activist hedge fund Trion Fund Management seems to have taken the Mouse House by surprise as he makes his second attack on the firm in less than 12 months, adding pressure to Bob Iger's big strategic plan. And reportedly, his stake valued at more than $2.5 billion.
Yeah.
And he's going to push for these seats. He did it earlier in the year and then sort of backed off after Disney unveiled a sort of a reorg.
Yeah, it's a Groundhog Day kind of vibe.
Yeah, but I guess he wasn't pleased enough with what that yielded.
No, I mean, at your point, the Journal noting he owns a lot of stock.
Yeah.
And he can't be very happy with how that stock has been performing. And I guess Disney would say I guess they'd say we're making changes. They talk about the cost cutting. Iger's been talking about ABC and ESPN and getting streaming to profitability. But now this is about the last thing he wants. All these changes and now maybe a proxy fight.
I mean, I was compiling a list of everything going on that's affecting Disney right now.
Yeah.
You've got the strikes. The actor strike still happening. Writer strike seems to be wrapped up. The battle over fees with Charter happening. They do plan to reinstate the dividend this year. That's on course. Yeah. They did raise the prices for streaming. They plan to spend $60 billion on parks. You don't want me to keep going? You get the idea here. And the stock has been down. And Bob Iger, at least to the outside world, still has not come up with a more formalized succession plan, which is what sort of torpedoed things and got him back in there in the first place.
And now throw Nelson Peltz in. How's that sit? Yeah.
There you go. Add him to the list.
Moving on, Tesla stock has taken a dip today after new data from China shows that the appetite for its electric vehicles made in the country has decreased by 10%. Actually, the stock there now, you can see battling back to the flat line. In the last year, new report by the China Passenger Car Association found sales were down for both the Model 3 and Y cars, and it comes after the company had a difficult run last week also, reporting delivery and production data that was less than the previous quarter. So this is interesting. Tesla, we know, Elon Musk, not shy about the strategy. He's been cutting prices hard. It's a volume game, even if that means you'll at the expense of profit margins.
Yeah, and It's interesting, too, that Tesla has sort of followed the shape of the market today. In other words, it was falling more this morning,
and then bounced
in
back
part on this China data, and now seems to have come back. But at the same time, if you look at the China EV makers, they have been under a lot of pressure today, and I don't believe that we have seen the same kind of recovery when it comes to those stocks. I've been watching the likes of NIO and XPeng and Li Auto today, and indeed, they're still down on the day, so not catching a bid as the day has gone on like Tesla has.
Yep.
And also, we've been watching health stocks today, a couple of different movers within that space. Let's start with Bristol Myers Squibb. Those shares are trading lower after it announced plans to buy the drug maker Mirati Therapeutics for $4.8 billion. The move will see the company expand its aging portfolio of cancer drugs. It had to slash its revenue outlook this year after sales of blood cancer drugs fell against other generic rivals. Mirati shareholders going to get $58 a share in cash. By the way, Mirati shares are also falling today because there's some talk about the price potentially that Bristol Myers is paying for it. So that's something that we're watching. And then also in healthcare, we're watching another company in that space as well called Alnylam Pharmaceuticals. Those shares down by 5.5% after U.S. regulators denied an application for one of its drugs that would have expanded the use of that drug. So those are some of the healthcare.
Bristol's really interesting because Bristol is, I guess the strategy there, Julie, is so we're going to build out and broaden our portfolio here of oncology treatments because we're dealing with these patent expirations. But it's interesting, not a lot of enthusiasm from investors here.
Not a lot of enthusiasm, although I was looking through some of the analyst commentary and they seem to be broadly positive on this. I think there was a little bit of thinking that there could actually be a bidding war for Alnylam, and now seeing analyst commentary, there seemed to be less thought that that could happen, so that might be one of the reasons that the shares are trading. Wait, did I say Alnylam? I meant Mirati.
You said it perfectly, though. That was what was impressive to me about that.
Coming up, Ozempic's popularity. We're going to break down how the diabetes drug could affect the food business. That's after the break. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The popularity of the new class of weight loss drugs raising questions about the long-term effects on other industries, and the prime target so far has been packaged goods. Our next guest recently published a note on just that. Joining us now, Pam Kaufman, Morgan Stanley equity research analyst. Pam, as you know, the talk around this has just reached a frenzied pitch over the last week or so, with executives from companies weighing in as well. Help us quantify the risk here for the food industry from these GLP-1s.
Sure. Hi, and thanks for having me. So we see long-term implications across the food ecosystem from the growing adoption of GLP-1 anti-obesity drugs. We see implications for packaged food, restaurants, beverages, and food retail. Our biopharma analysts expect drug use to grow 5-fold over the next 12 years and project that about 7% of the population is going to be on the drugs by 2035. Given that the drugs have a significant impact on people's appetites, they will have an impact on long-term demand for food consumption.
And Pam, so you're seeing obviously real adoption here. There are barriers though, Pam, and listen, you know this about access and affordability. These drugs are expensive. So as part of your forecast, what variables does that depend on? Does that depend on the prices coming down or insurance coverage kicking in?
Yeah, so our pharma analyst forecasts are based on increasing insurance coverage, but right now there are about 45 million commercial lives covered for obesity treatment. And over time, there's potential for Medicare to also extend the coverage for obesity drugs. Over time, the cost should come down. Right now, the average out-of-pocket for people who are covered under their health insurance is about $25 a month. But some people are having to pay out of pocket if they don't have the coverage. And as more drugs come out, the price will decline over time.
Well, over time is really a key piece of all of this, isn't it, Pam? Because there's been sort of this stock freak out and sell-off. Do you think that's justified given that maybe magnitude-wise we're talking about a big deal, but we're also talking about pretty spread out over a span of time, right?
Yeah, so in our model, we forecast that there's going to be about a 1 to 2% headwind to overall calorie consumption by 2035. That's because the drugs do have a very significant impact on people's calorie intake. There's about a 20 to 30% reduction in daily calorie consumption when taking the drugs. That's how they drive 10 to 20% weight loss within a year. And we did do a survey where we asked 300 patients who are currently on the drugs how it impacts their food consumption. There's about a 20% reduction in the number of daily meals, a 40% reduction in daily snacks. So we do see a more pronounced impact. We expect a more pronounced impact on less healthy categories, such as snacking, where the impact can be greater than the 1 to 2%. We project it can be up to 3%. And that doesn't factor in that the people who are currently taking the drugs, that only considers the impact on the people who are currently taking the drugs. But there could be a broader implication if it extends to changes in behavior to people in their households.
And Pam, as you look across your coverage universe, then, at all the names you're covering, what are some of the winners, do you think, potential winners from that trend?
Sure. So in terms of the winners, we think that the companies that have exposure to better for you categories and weight management foods are actually winners from this trend. It's a bit counterintuitive, but that was one of the surprising things that came out of our survey work. People cut down on their food consumption across pretty much every category, with the greatest reduction in consumption across less healthy foods. And there were only a few categories where people ate more of them, and those included weight management foods like protein bars and protein shakes. So in my coverage, the companies that have exposure there and can benefit include Simply Good Foods and BellRing brands, where overweight both of those stocks, in part because they should benefit from this trend.
So, Pam, bottom line, do you think investors should be acting on all of this now, particularly on the companies that might be negatively affected?
I think that the implications are longer term. Investors are factoring in the longer term impact into their long-term projections and their terminal growth rates for the industry. We've seen companies like Hershey and Mondelez react negatively to the risks around GLP-1s. We don't expect to see a financial impact in the near term, but it can affect their long-term growth outlooks.
Pam, thank you so much for your time today. That was Pam Kaufman from Morgan Stanley.
Thank you.
And a big day coming up in the trial of FTX founder Sam Bankman-Fried, the testimony of former Alameda Research CEO and his former girlfriend, Carolyn Ellison. Yahoo Finance's Alexis Keenan is here with a look at what to expect. Alexis.
Yes, Josh, a consequential potential day. Tomorrow, Ellison is expected to testify in that criminal trial, and she's expected to testify against Bankman-Fried to say what she knows about the hedge fund's relationship with the exchange FTX. Now, we learned last week during the trial that Alameda had really unfettered access to FTX's customer funds. Now, prosecutors say that Ellison and Bankman-Fried both knew that Alameda was illegally tapping into FTX customer funds for these uncollateralized lines of credit, margin deficits, all that they said they knew they couldn't repay. Now, Ellison started for Alameda working there as a trader in 2018. She then began leading the company as its CEO in 2021. She has since pled guilty to multiple felony charges. She is awaiting her sentencing after cooperating with prosecutors. And also other top lieutenants of FTX and Alameda that we heard from last week, they carried some of these same stories. One of those was FTX co-founder Gary Wang. He was a software developer at the company, and he testified that back in June of 2022 that he and Caroline Ellison, as well as Bankman-Fried and other insiders, that they had a meeting over what amounted to an $8 billion negative balance sheet for Alameda. And according to Wang, Wang said that it's Bankman-Fried who told Ellison to go ahead and repay Alameda's lenders using customer funds. Now, the problem there, of course, is that that wasn't possible without using customer funds, that they would have to tap into Alameda's coffers in order to make those lenders whole. Now, we'll be listening tomorrow for Ellison's testimony about what she says Bankman-Fried knew, but a lot to still be learned about this collapse tomorrow as Ellison, I believe she's now 29 years old. And as I said, she's awaiting her sentencing according to her testimony. Prosecutors will then write a letter when it's time for her to be sentenced, saying whether she did in fact help the prosecution go ahead and prosecute its case against Bankman-Fried. Guys?
Well, I imagine that information will be helpful, and we'll be monitoring it. Thanks to you and getting an update on it. Thanks so much, Alexis. Well, coming up, oil prices climbing today in response to the Israel-Hamas conflict. We're going to break down whether or not those prices are here to stay.
Oil prices rising today as war breaks out between Israel and Hamas. The attack stretching into their third day. Crude and Brent both up over 4%. And joining us now is Pavel Molchanov, energy and clean tech analyst at Raymond James. Pavel, let me start there. I'm looking at Brent. It's over 4% to 88. How do you think this new war between Israel and Hamas could affect the price of oil going forward? I realize, Pavel, listen, it's a fluid, dynamic situation, a lot of moving parts, but how are you thinking about it?
Israel and all of its immediate neighbors, the Gaza Strip, West Bank, Jordan, Lebanon, and Syria. None of these countries or territories produce oil in significant quantities. Let's just put that on the table. The only way in which this war could physically disrupt oil supply is if Iran makes a decision to openly enter the war on the side of Hamas. Now, Iran has had more than 4 decades since the Islamic Revolution of hostility to Israel, but not once during that time has Iran openly engaged in a military confrontation with Israel. Why? Because the Iranians know that they would lose. Israel is a nuclear-armed country and has the largest air force in the region. If Iran does this, it would be their biggest mistake in 4 decades, and I do not think the Iranian regime is suicidal. So the odds that this war will have a physical effect on oil supply from the Middle East is very low.
Pavel, it's Julie here. It's great to see you. Josh and I really enjoyed your note that you wrote with your colleagues looking at the history of conflict in that region, now 50 years since the Yom Kippur War. You just talked to us about some of that, putting that what's happened in context. But as you also point out in that note, a lot of other things have changed between then and now in terms of the dynamics of the oil market. So what do people need to keep in mind, sort of thing one, as they watch what's happening on the ground there and as they watch oil prices go up?
So here's the good news. Even in the worst case scenario of Iran getting into this war explicitly on the side of Hamas, again, I don't believe this will happen, but even in that scenario, the world has enough strategic oil reserves to provide more than enough cushion for such an eventuality. So in the United States, there is the Strategic Petroleum Reserve, SPR. All of the other members of the International Energy Agency, so all of the European countries, Japan, Korea, Australia, they all have their own emergency reserves. And that is something that did not exist in 1973 during the Arab oil embargo. So compared to 50 years ago, when some of our listeners will remember there were gasoline lines, there was a 3-day work week in the UK because of fuel shortages. None of that would happen, even if Iran, gets into this war. The world is prepared, and indeed we saw this during the immediate aftermath of Russia's invasion of Ukraine in February of last year, when prices spiked on fears that what if the Kremlin decides to cut off its oil exports, but then the emergency stockpiles were gradually drawn down. And guess what? Prices dropped at one point, by 50%.
And Pavel, you point out in that note too as well that we do have this, we have this framework now for maintaining and sharing emergency oil stockpiles, but also, Pavel, what's the track record we should know about when it comes to politicians using and abusing those assets?
Well, look, the history of having, particularly the American Strategic Petroleum Reserve, is that presidential administrations on both parties have used it not just during emergencies, but also to push down oil prices just because prices happen to be high, especially before an election. So, we've seen this going back to, the Bush administration. It happened under Obama. It happened under Trump. We'll see if it happens under Biden, if prices go up ahead of November 24. That is not how these stockpiles are supposed to be used, right? That is bad practice. But the political reality is the oil is sitting there, and of course, political officials will make politically motivated decisions. The fact of the matter is there is still more than enough oil in inventory to provide enough cushion for any emergency that might happen, whether it involves Russia, the Middle East, or it could be something that's non-political. For example, hurricanes in the Gulf of Mexico. So there is more than enough cushion, and nobody needs to be worried about gasoline shortages.
So, Pavel, just quickly then, before we leave you, absent any real effect from this war in the Mideast, What's your oil target? How much more upside do we have?
So the much more important than this war itself from the standpoint of the oil market is the fact that Saudi Arabia and Russia are both extremely disciplined with their supply. Assuming that they continue to be disciplined, and also assuming that the global economy does not go into a severe recession, there is a good reason to expect oil prices to reach $100 a barrel, triple digits, at some point over the next 6 months. We got to $120 a barrel shortly after Russia invaded Ukraine. We're not saying it's going to go quite that high, but look, a week ago, oil was getting very close to 100. Then the market took a bit of a dive. It's seeing some gains today. Obviously, always volatile commodity. But yeah, we think $100 in the next 6 months is a pretty good bet.
All right, Pavel Molchanov from Raymond James. Pavel, thank you so much for your time and insight today.
Thank you.
And coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
You just heard the closing bell on Wall Street, so let's do a quick check of the markets with that enthusiastic gaveling at the close there. We saw stocks, and not quite at the highs of the session, but near them. The Dow finishing up by about 197 points. That's good for a gain of 0.6%. Similar size percentage gain for the S&P 500. And the Nasdaq up by 0.4%. And I wanted to dig into the action a little bit further today, because as we've talked about kind of the big underlying forces in the market today, one could say were twofold. One, of course, Hamas's incursion into Israel, declaring war against Hamas in retaliation, the fallout from that, including a surge in oil prices on the one hand, and then on the other hand, Fed speak throughout the day, indicating the Fed is perhaps going to be a little bit more careful about raising rates at its next meeting. So, Josh, I'm just taking a look at all of the moving groups within the Yahoo Finance Interactive right now. Energy far and away the best performing group with the surge in oil prices here, up 3.4%. Industrials also doing well. The defense names within that industrial sector, but real estate, communication services, all groups that actually financials flipped from red to green just in the final few moments of the session here as we saw that move. So really quite a switch here as we got further into the day.
Oil names working and defense names working. The question becomes, I think, does that carry through for a few sessions?
Yes, and it's a good question. One of the other things we were watching throughout the session was the knock-on effect for travel stocks. And here you see the travel stocks here. I'm going to equal weight them so we get a better look at what was up and down. And most of them did not recover before the end of the day. Yes, you had the likes of Spirit and Airbnb and Wynn that ended up eking out some gains by day's end. The airlines, though, still taking a big hit. After all, conflict or no conflict, fuel prices have gotten higher for them. Then you have Carnival Cruise Lines on this list, and most of the other cruise line operators also suffering on the session, which was also quite interesting to watch as we headed throughout the day. In other words, even though the overall market recovered, there were some subsectors like travel that just didn't.
Yep. Moving on.
Okay.
I need water, some kind of. We're going to get through it. I promise we'll get through it. Turning out the latest sentiment on ARM Holdings. Wall Street analysts initiating coverage of the company after its recent IPO. ARM seeing a flurry of upbeat coverage among some more cautious notes. ARM interesting, Julie, because we know there were some concerns here about valuation, about, of course, the smartphone market, which has slowed. But it seems like analysts with these initial coverage initiations, at least selling some buys here, the equivalent of buys. Jefferies, for example, likes the fact that they're expanding its portfolio to include CPUs for the data center market. And remember, when we talked to the CEO of ARM, Rene Haas, that was one of the points he made. Is like, listen, we're not just smartphones. We're moving hard and fast into new verticals. At least some analysts are sold on that.
Yeah, it seems like a lot of the analysts were pretty sold on it. Although there were, I think, a couple of holds out there, concerns about valuation. As we know, also the stock hasn't gone up in a straight line. In fact, it's gone down more or less since the IPO. But it does seem like overall there is even. What was fascinating to me is that in some of these initiations I was reading, AI wasn't the thing that was sort of emphasized, even though that was before the IPO one of the selling points. It was more just that ARM is sort of a vital part of the semiconductor ecosystem in its architecture that it's responsible for.
Yeah, there are, when you talk to analysts, here's what they'll say about AI. And it's true, ARM did push that. What they'll say is, listen, they'll kind of describe it as a secondary player. In other words, They'll say, well, NVIDIA, with some of its new data center chips, it's combining its GPUs with ARM CPUs. In other words, it is a player. How much that story holds up and convinces investors, we'll see.
Yes, we will. There's one more mover that we want to talk about, and that is Rivian. Facing some heat as Wedbush slashed its price target on the stock to $25. Analyst Dan Ives over there noting the company's $1.5 billion convertible debt offering, delivering another gut punch to investors. What I find funny about this, and all respect to Dan, who's a friend of the show, $25 is still above where, he's still an outperformer.
He's got an outperformer. He's still a buyer, takes his target down. I think what he says here, he's still a believer long term. He still is a believer in the growth prospects, but his confidence, he says, has taken a bit of a hit, although not enough to change the rating.
He said, one more. It's like the kids in the back of the car. One more time, one more big misstep, he says, like this convertible offering, would be the final straw that broke the camel's back for many bulls, including ourselves. So, this is your last chance, Rivian.
It's exactly what I tell my 4-year-old. One more time, Sid.
One more time.
Though Ives will say.
Then do you follow through?
No, she was on my total pushover.
So this is the question.
No,
Will Ives follow through?
She's already got my number. I will say Ives not alone, though. 60% of analysts still like this name. They still think it's a buy.
We'll see.
A lot of confidence. All right. Birkenstock gearing up for its initial public offering this week. The company will be the latest addition to the list of high-profile public listings. That, of course, includes ARM and Instacart. But with a wobbly IPO market, investors may want to think twice before jumping into the new stocks coming to Wall Street. Joining us now is Torch Capital founder and managing partner Jonathan Caden. So, Jonathan, let me start there. We've had this trickle of IPOs, Jonathan. ARM, Instacart, Klaviyo, maybe Birkenstock ready to test the waters. I'm interested, what do you make so far of the reception these names have gotten from the public market investors, Jonathan, and what does that response tell you, if anything?
Hey, Josh, great to be here. It's rocky. We are not in the clear. People thought the IPO market would be opening. This is the beginning. I think it's going to continue to be very uneven. Klaviyo and ARM went up, but they're back to around their IPO price, and Instacart's, I think, trading at about 15%. So it's still a lot of uncertainty and definitely not an open market. And at Torch, we've been advising our companies to probably hold back till next year at the earliest until we see what's happening. I still think stocks are overvalued. They haven't been, discount rates are higher, and there's still probably rate hikes ahead than the stock prices have priced in. So we're still very cautious and think it's going to be uneven for a while.
John, this is so interesting because obviously you've invested in a lot of companies on the private side that you think are worth it, investable at the valuations that you're offered. But I'm curious, if I'm a public market investor and I'm interested in these IPOs, like what kind of criteria should I be using? How do I know if Birkenstock is worth buying, for example?
Well, I think you also, to start, should look at comparisons, right? That would make it bigger, the third biggest footwear brand right behind Nike and Deckers. So bigger than Crocs and Steve Madden and Skechers and a ton of other huge companies. It was also valued at $5 billion in 21. So that's one thing, just where you think it falls on that line. The second thing is, how are consumers feeling? What do we think consumer behavior is going to go? At Torch, we look a lot at consumer behavior, not just where it is right now, but where it's going. And I think in the long term, it will be a very valuable company. It's very much in style, ingrained, long history, authentic brand. But it looks like consumer spend is going to be challenged as well. There's been talks of recession for 2 years now. It hasn't happened, but it doesn't mean it won't happen. And when you think about what's a must-have, a need-to-have item versus a nice-to-have, Birkenstocks falls in a nice-to-have. And if people are tightening their belts, that may be the type of purchase that they may not make at the, in the next year or two.
John, how many pairs do you have?
I actually don't have any, but I did a long time ago.
Fair enough. We were discussing that recently amongst our team and how they've had a resurgence. But Josh,
I got two, Jonathan.
Yeah,
I can loan you a pair if you want. I don't know if you want them if you're interested, but the offer's out there.
You see them out all over the place. It's amazing, when you think about the style trend of high and low, sort of something very fancy with something sort of more basic. They've nailed that, and you see people out in New York City at very nice restaurants and clubs, and they're still rocking a Birkenstock with a fancy dress or a very nice outfit. So they have done incredibly well as a brand and positioning as a style company. It's just, where does that fall in the bigger macro equation?
Yeah, you can't take them out to dinner, Jonathan. You wouldn't take my pair out to dinner, but I take your point. But let me ask you this,
Not
John.
mine or not yours.
Dynamic.
Maybe Julie's.
Right. Another interesting dynamic I want to get your take on, Jonathan, is just the backdrop here is that for the first time in a long time, investors do have alternatives. You can duck into T-bills or boring old money market funds yielding 5%. Does that change the kind of company, Jonathan, you think can go public right now and win over public market investors?
Yeah, absolutely. I mean, I think there's a risk-reward equation that investors have to continuously be making. I do think if you're too safe, you're going to miss out on a lot of opportunity, but there's real risks in this environment. And so, like I said, Torch has told our companies to hold back on IPOs, and you really have to be very clear-eyed on what the real growth potential is based on the price that it's going out at. For where Torch normally invests, yeah, exactly. We're looking across the consumer ecosystem, companies like Acorns we backed, and Roman or Ro Health, a telemedicine company, or Ro Banking, or DigitalOcean, which had a very successful IPO a couple years ago. We're really focused on the early stage, and I think there's tons of value there. Valuations are down. Capital is much harder to raise. We're seeing much higher quality founders. They're raising with less capital, so they're forced to be more focused. And as we've seen historically, the most resilient companies are built in the most turbulent times. And so we're investing of where is the market going to be in 3, 5, 10 years. And early, we're getting in at a low enough point that I think early stage venture continues to be a great asset class. And I think 2024 vintage is going to be probably one of the most successful vintages in recent memory.
That's really interesting, John. And then on the flip side, when they are ready to come public, like what is the sign for the all clear that you would be looking for going into next year? Is it a crop of other decent IPOs, or is it more sort of general market conditions?
I think it's three things. Definitely general market conditions. You can't swim upstream. I think it's some successful IPOs that sort of correlate to your sector. So the recent comps that reset where pricing is and give people confidence. And the third thing is, you never heard this the last 3 years. I mean, we witnessed one of the biggest bubbles in venture and tech history. But How profitable are they? What is their actual potential cash flow positivity? Discussions that weren't being had 2 years ago as all these SPACs and IPOs came to market, and they got punished for it. So it comes back down to fundamentals. You have to believe in a big growth story, but then you have to have that somewhat proven out and a clear line path to where that goes, much clearer than it was required 2 or 3 years ago. And so really all three of those come together to make, I believe, a successful IPO.
All right, Jonathan Keaton, that was great. Appreciate it. Thank you, sir.
Yeah, pleasure to be here. Thanks a lot.
And coming up, switching sides, Robert F. Kennedy Jr. announcing he'll run for president as an independent. What could this mean for President Biden? That is next. Robert F. Kennedy Jr. has abandoned his run against President Biden in the Democratic primary and instead will run as an independent. Yahoo Finance's own Rick Newman joins us now. Rick.
Hey, guys. Well, I don't think Biden was real worried about RFK Jr. As a Democratic challenger. The question now is, does Biden have to worry about him as an independent? And if there is a concern here for Biden, it's that people would associate RFK Jr. with Democrats, and people with Democratic leanings who might be on the fence during a general election might vote for RFK Jr. instead of Biden. And that could matter because in 3 or 4 swing states in 2020, the vote in favor of Biden in each case was decided by way below 1% of the voters. So a little swing in an important swing state could actually swing this election one way or another. Now, an interesting thing here is that the Trump campaign thinks that RFK Jr. could also be a danger to Donald Trump. In other words, it might not be Democratic-leaning voters who are interested in RFK Jr., but it might actually be more Trumpy types of voters. I mean, RFK Jr. actually in some ways sounds a lot more like Trump than he does sound like Biden. I mean, he's famous for his anti-vaccine rants and conspiracy theories and things like that. So if RFK Jr. Makes any difference at all in the 2024 election, we really don't know whether it's going to be a little bit in favor of Biden, a little bit in favor of Trump, and both campaigns are trying to suss this out at the moment.
Yeah, it's fascinating to watch that go on. Also fascinating, of course, we were expecting the debate for the next House Speaker to start this week, but now there's a possibility we might see the return of Kevin McCarthy. Right after he lost his position, he said he wasn't interested in jumping right back in, but now maybe he is?
Well, he was pretty much of a wounded duck. And maybe even a dead duck after his Republicans fired him basically last week. I mean, it seems like a long time ago, so much has been happening, but I think it was only 6 days ago at this point. So now there are two other, what you might call frontrunners, I guess, Steve Scalise and Jim Jordan. But neither, I mean, both of them, each of those members of the Republican Party has his backers. But neither of them is close to having a majority of the vote lined up. And it's not really clear that Republicans are going to be able to elect either one of those guys. So, McCarthy is he's a shapeshifter. He's obviously extraordinarily ambitious. And he has volunteered himself selflessly to the Republicans. If Jim Jordan or Steve Scalise doesn't work out, maybe he would be willing to give it another shot as Speaker. So, if the other two guys can't work it out, Kevin McCarthy can come and save the day.
We'll see if that's what he actually ends up doing. Rick, thanks so much. Appreciate it.
Bye, guys.
Well, the move to electric vehicles proving itself to be a winding road. As part of Yahoo Finance's week-long special, EVs, the road ahead, we're taking a look at the biggest challenges in place for the EV transition. Yahoo Finance's Pras Subramanian, of course, is here with the details. So, Pras, what are some of those challenges?
Yeah, as this kind of transformation takes place, we're watching these things over the next week. I feel like there's three things that we should watch out for: labor, demand, but then also the cost of materials. So these are the three factors that I sort of am watching and come into play. So we'll start with labor here. This is obviously front and center right now with the UAW strike happening right now. It sort of comes at the worst time for the big three as they're ramping up investment to build out their EV facilities, but spending billions here, also losing hundreds of millions here because of the strike. And conversely, for the union, making EVs requires fewer jobs in general. It's simpler to make, there are fewer moving parts, fewer cast parts to use. So the unions are sort of concerned here about that, which leads to more rancor and maybe calls for job security. Secondly, demand. The demand picture, EVs sold last quarter around 9%, 8% of all light vehicles sold in the U.S., steadily creeping up, but still sort of tailing off in some regions. A big part of it is cost. KBB finds EVs cost on average $18,000 more dollars than gas-powered cars. That's sort of a big deal. It's a huge premium hitting demand. And conversely, this is why the EV tax credit is so important here, right? So, problems like infrastructure and demand anxiety don't help with demand either. Finally, cost of materials. Despite fewer labor inputs, EVs cost more to make. That's just a reality. Legacy automakers spending billions of dollars to sort of make these factories to get these cars online. But once you're online, they have to pay for materials like lithium, cobalt, nickel, all in large quantities. When it kind of pair it all together, supply costs, things like that, these costs for these cars, EVs, are kind of rocketing higher and leaving automakers with a conundrum here. Either you eat the cost and hurt margins, or pass the costs on and hit sales. So these kind of things we're watching here as the EV transformation hits this big green tidal wave, as some are calling it.
Pras, thank you for that.
Thank you.
And healthcare has been one of the most talked about sectors in 2023, benefiting from increased innovation and the growth of AI, but also at risk from rising rates and fears of a prolonged economic slowdown. The Health Conference in Las Vegas boasts some high-profile delegates from the industry. from hospital groups all the way down to startups. Yahoo Finance's Anjali Kamlani spoke with Kroger Health President Colleen Lindholtz. They discussed the company's notable push into the retail health space, as well as a topic that's front of mind for many in the industry, weight loss drugs. Take a listen.
The GLP-1s, they've been around since 2005. Not sure if you realize that or not, but the original Trulicity that came out a long time ago. For type 2 diabetes, they've been out quite a long time. But you know, with any drugs, there's side effects, and the side effect of the GLP-1s was actually a good side effect, in that it caused people to lose weight.
Right.
And so, you know, over the years, obviously, there's been many different other drugs come out. There's one pill form on the market right now. But what I can tell you is that with the injectables, there are some they're hard to use. They have storage requirements. So but they have been blockbuster. I have to say, they've been blockbuster for some people. And I have to say too that, like, even the people that I know that are on them, they're pretty much, when they're able to lose weight, like they've tried diets over the years that have been really tough, when they're able to lose weight and in a pretty fast amount of time, they start to feel really good about themselves. They start to really change their behavior overall. So we're studying that right now at Kroger, but I definitely, from knowing people that are on those drugs, it's they're blockbuster for them, especially if they've tried diets over the years, and more of like a kickstart in a new lifestyle.
So it's not necessarily that they're eating less. That's not necessarily what you think will be the case, or you're not sure yet. You're still looking at the data?
Yes, yeah, we're still looking at that.
Okay.
So the way the drug works overall, people are eating less, but I believe it just makes sense that people are going to trade up to fresh foods, things that are like better for them, because they're feeling good about themselves and they're feeling good about healthy overall.
Talk to me about on the pharmacy side, though. You're tracking that obviously as well, the increase in use there.
Yes.
I know there's a nationwide shortage. I know we've seen a lot of payers pull back on covering it. But what can you tell me about the impact you're seeing of these the newer GLP-1s, at least, in the pharmacy side?
Yeah, so Wegovy, which was the one that was officially approved for weight loss, has really taken off, and it's really been in retail across the board. There has been some shortage in getting the medication, so we've had people that have been waiting on it, but for sure they've been blockbuster, and we've been filling a tremendous amount of the drugs since really the beginning of this year.
Talk to me about the clinics. I think not as many people necessarily associate that with the brand. There's been this huge push into retail health. We've seen CVS, we've seen Walgreens, we've seen Amazon, big moves in this space. You've been around for some time. Talk to me about the impact there. Do you feel like it's sort of a slow and steady pace that things have been growing at, or is there more to come?
Yeah, so our retail clinics, the Little Clinic, it's under the banner the Little Clinic. They've been around and a part of the Kroger family since 2010. So we've had them for quite some time. And it is very interesting how really healthcare is coming to the people these days versus people going to healthcare. So the great thing about our retail clinics is that they're open 7 days a week. You know, unlike when people can't get into their doctor's offices, late hours, that type of thing, we're open. We see a wide range of things in our clinics. We take care of a lot of acute issues, you know, people that get sick, strep throat, that type of thing, kids' physicals. And then we also take care of people with chronic disease. So because there's a shortage of primary care physicians in the United States, we act as a primary care physician for many different people. So we're really proud of really the depth and the breadth of what our nurse practitioners and our physician's assistants have been able to do in the community. And I think there's lots more to come, especially when you think about the country moving from a fee-for-service model to a value-based care model, and what will that mean? And we believe we're going to play a huge part, not only from our clinic side, but then from our pharmacy side in helping people live a healthier life.
I know that there's definitely a lot of focus also on the food side and food deserts as well. The social determinants of health has become a big phrase in the industry. Talk to me about some of the partnerships. I know Bayer is one of them. Some of these partnerships that you're helping, and whether or not you're able to gather data to measure the impact that you're having there.
Yeah, so when it comes to nutrition, we have been working for quite some time on our Food as Medicine platform. So have you seen anything or heard anything about our Food as Medicine platform?
Yes.
Yeah, so it's really, we've defined Food as Medicine as a dedicated, educated, and personalized approach to helping people enjoy food so that they can live a healthier life, and then we can prevent disease before it starts. What's awesome about our Food as Medicine platform, it is anchored by a nutrition scoring system called OptUp. So we've been working on this for years also. And to really combat what's going on in the country with food insecurity, we call it nutrition insecurity, we've got to have a system to be able to measure food. And so we've been working on that with a bunch of different partners to really bring transparency and really simplify customers' healthier choices for them. So it's a system that's red, yellow, green, and really it helps people if they want to opt up to something like in a commodity like cereal or like yogurt. It helps them make a better food choice to opt up to something that has more nutrition value. So we have multiple partners that we're working with, both on the health plan side to really prove out food as medicine, and on the pharmaceutical side to bring solutions and tools to the consumer that again makes it easier for them.
And so this is part of like an app that they would use?
So it's actually embedded in our Kroger app and in our Kroger website. We did develop it outside of the company a while back, and then we brought it inside of the company so it would be better for the customer experience overall.
So a lot of this going back to the point of really meeting the customers where they are, getting them into the system and making sure that you're able to monitor that. Do you see a long-term use for this kind of data in terms of what you're going to learn about the customers and how that translates to the use for the healthcare?
Yes, I do. So we really believe that the future of healthcare is personalized, not generalized. And when we talk about personalization, we can really take it to a new level, especially with the customer's permission. So I want to make sure that you know that we don't do anything with our data without the customer's permission. But when we're able to do that, it is amazing how we're able to tweak, whether it be diet or education or even on the pharmaceutical side, to what the patient's needs are. Like right now, if I would suddenly get diagnosed with something terrible like cancer, then my journey would change very quickly. And so what we're working on is that personalization really more than anybody ever has. And because Kroger has a data analytics wing of the company that's been studying customer behavior for a very long time, it's called 8451. If you've heard of that data analytics wing, we know customers very well. And again, with their permission, I think we're able to do things that really meets them where they are on their health journey in life.
That was our Angelique Emlani with Kroger Health President Colleen Lind Holtz. Coming up, the AI boom is causing companies to rethink how they do business. We'll hear from one CEO whose company uses AI to help clients control costs. That's next.
auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead, right here on Yahoo Finance.
Supply chain disruptions during the pandemic bringing several significant logistical challenges to light, especially a need for modernization in the $25 trillion global cargo trade. Amid the push for more digitization in freight, startup Loop is focused on putting AI-powered tools to work in aiding logistics companies. The company, Loop that is, just raised $35 million in Series B funding led by JP Morgan Growth Equity Partners. Joining us now, Matt McKinney, Loop co-founder and CEO. Hey, Matt, thanks so much for being here. We all saw sort of the vulnerabilities that were exposed during the pandemic in logistics and supply chain. You guys are focused on particular, if I'm not mistaken, on the way that these companies sort of pay each other. Can you talk us through that exactly?
That's right, and thanks for having me. At Loop, we're specifically focused on unlocking profit that's trapped in the supply chain with our modern audit and pay system. And we're solving a very important problem in this, which is invoice costs do not always match your expected contracted cost. In fact, up to 20% of the time, you can have an error on your invoice. And so some companies are losing unnecessary profits and decrease their working capital due to this issue. And you might be thinking, well, why is this such a problem? And the logistics industry, it has so much paperwork, you have manual workflows, and you have these very complex contracts. And I like to joke, you need a PhD in freight billing to even understand what is going on. And so what this does is it creates a reconciliation nightmare for companies. I mean, it actually takes 50 days on average to process and pay these bills. And that friction is not free. It locks liquidity, which increases cost, and then those costs are passed down to us, the consumers, which is why Loop is here to remove this tax that's being levied on the American consumers and helping companies unlock profits.
And Matt, Julie mentioned this $35 million investment you secured. What is that going to mean for Loop, and how do you plan on deploying that new money, Matt?
We're very excited to bring both JP Morgan and Index Ventures into Loop, and where we're specifically deploying it is today we focus on over-the-road trucking, but we've had our customers come to us and say, we'd also like to get exposure on our ocean and air. So we're expanding in ocean and air and adding additional customer segments that we're going after.
The timing of all this is interesting to me, I have to say, Matt, because shipping rates have come way down. We've seen a lot of the alleviation of some of the pressures that were affecting both the shipping and the trucking industry. So one would think that they have less money to spend right now. Is that what you're finding?
Well, there are a couple of things going on. One, we've got a little bit of the COVID hangover where rates skyrocketed and now they're coming right back down. But if you look at the broader macro, an important underlying structural shift is happening where companies are diversifying their supply chain. They're moving off of China and other areas of the world onto nearshore and onshore. What that does is that forces companies to reshape their supply chain, to evaluate where they should be opening new routes and new trade. And this is something that doesn't happen every single year. This is something that companies haven't faced in the last 30 years. And so while rates are going down, it's even more important now to get control on their costs, because as those manufacturing plants come to North America, that's inflationary and that's going to drive up costs. So companies really have to be smart about building a next generation supply chain that doesn't increase costs for their consumers.
And Matt, your own personal story is interesting too, because as I understand it, you met your co-founder when you were both at Uber. What did you see, Matt, at Uber that sparked this idea for Loop?
Exactly right. I mean, at Uber, my co-founder and I met. He actually is famous at Uber for building search infrastructure for Uber rides. But the problem was so in our face, which was fundamentally a data problem. And our backgrounds are uniquely positioned, both from the data science and engineering background, to go solve this problem. We were focused on a lot of the front end, which is how do we grow the revenue? But on the back end, we noticed a lot of friction in how companies are getting paid. And we saw this as a massive opportunity to go after and solve for the entire industry.
And Matt, as a founder, I'm just interested, last question here. What are the big challenges for you right now going forward? Is it trying to secure talent, Matt? Trying to hire and find the best engineers out there?
That is certainly the most important challenge that we face today. I mean, with the AI hype that's happening right now, we are so fortunate to be able to attract the top talent in that field, but we're competing against other very large and well-funded companies to go get this talent. So bringing them, exciting them, and showing the real world impact that we're having. We're not just another chatbot. We are truly transforming the way that people get paid in one of the largest industry that contributes to global GDP.
Matt, thanks for being here. Matt McKinney of Loop. Well, coming up, we're going to go around the horn with today's top stories, including activist investor Nelson Peltz push for board seats at Disney. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
We might be on Cornelia Street right now, but Taylor Swift is definitely not heartbroken. From a $5 billion tour to a new movie on the big screen, Taylor Swift is all anyone can talk about. And her superstardom is expanding beyond the Billboard charts and having an unheard impact on the U.S. economy. From increasing viewership for the NFL to getting blamed for inflation, the Taylor Swift economy isn't going out of style, and we have all the details for you right here on Yahoo Finance. Welcome back to Yahoo Finance Live. I'm Alexandra Canal with Josh Schaefer and Pras Supermanian. There's a big story I want to talk to you guys about, and that is Disney, because Nelson Peltz and his Tryon Fund, they're launching a new attack on Disney after they ended their proxy fight back in February. Nelson Peltz wants to seek out more board seats, including one for himself. They also boosted their stake in the company, which is now valued at a reported $2.5 billion for more than 30 million shares. Yahoo Finance did reach out to our sources on this and said that Disney was surprised by this renewed attack from Peltz. I've spoken to a few analysts, though, and they have told me that largely they're not sure if there's anything Disney can do to really accelerate what they're already doing. Obviously, this company has been under a lot of pressure. Their shares hit a 9-year low last week. Investors aren't really sure about the long-term plan for this company. Clearly, investors like Peltz want them to do something about it, but the question is, what exactly do they do, and how long is it going to take for that to come to fruition?
I think Peltz is speaking what a lot of Disney investors probably feel, which is they liked Bob Iger's restructuring plan, which came in about February, right, if I'm correct? That was last winter.
It was shortly after.
When Peltz rescinded the initial activist bid at that point, right? They backed off.
I think it was
after the Iger earnings call, when Iger laid off the plan.
Because
they backed off because it sounded good, and then you take a look at Disney's stock over the last 6 months, and that sort of reflects that it's been a long-term plan. It hasn't been a quick-acting plan. And so I think maybe from an investor's perspective here, you're just looking for Disney to do a little bit more for me now and stop promising things later. They certainly have a big enough business that's been successful at times. They could work a little bit quicker maybe to just bring some profits back to the company in a quicker fashion.
But you have to think, this is not a quick fix thing. You're talking about major issues at this company and major plans moving forward. I mean, taking ESPN fully over the top as a direct-to-consumer streaming platform, that requires a lot of work. You need to figure out how you're going to price the thing. The NBA rights renewal deal, I'm sure, will come into play there. Also, how are you going to work out your contracts with other pay TV providers? So it's a long game, which Bob Iger seems to have, this 5 to 10 year plan. But to your point, investors are not really patient. They don't want to wait that long to see some of those returns.
I mean, I feel like I have deja vu all over again, right? I'm like, didn't we just see this happen already? Yeah. I mean, what's going to change other than like Nelson Peltz getting more money, extracting more money from Disney, right? He already took out his position. He was back in again. So I'm not sure what exactly has changed. I think there's a good point you're saying about how this is still in the middle of transformation. Like, it's not like Bob Iger's like said, I'm done now, it's over. He's like, no, he's still in the middle of doing it all. I think Saz brought up a good point in his write about this earlier today about how there's concern about Hulu and about is either going to overpay for this portion of Hulu that Comcast owns. The window opens up in January, I believe, and is concerned about stuff like strategic moves that maybe Nelson Peltz is not happy about, potentially more money being spent where he wants money to be cut. We'll see, but I think it's sort of like, it's just funny that this guy, like, barbarian at the gate again, right? Like, just you already cashed out. Now you're back and you're not happy. It's just so funny. And then, what was Disney caught off guard? Is that true?
That's what the sources tell us. And it seems like this hinges on a lot of hypotheticals, like what you were saying. When is this going to happen? How is it going to look like? When are we going to see any sort of revenue gain? And there are a few questions that I think on the earnings coming up in November that the stock could be hurt if Disney doesn't come out there and have a solid plan, especially when you think about profitability for direct-to-consumer. They've consistently said that the DTC services will reach profitability by the end of fiscal 2024. That's 4 quarters from now. So if they come out on the earnings and say they're going to delay that, if the subscriber numbers are really bad because of those price hikes, I mean, all of that could be a net negative for the stock. But analysts do see upside in the future.
It gets to what Pross was saying, though, too. When you think about Disney and you think about a lot of the analysts, Allie, that you speak to and tell us about what they're saying all the time, feel good about Disney because Disney has such a great brand, right? Disney has great characters. Disney has all these different levers to pull in streaming. So you could make a very compelling argument that they don't need to then go and buy Hulu, like Pross said. Like, I think from an investor perspective of wondering what's going on here, you probably just want them to stop spending money at some point. Like, yes, I understand how Hulu plays into the long-term 5 to 10 year plan, but that's more money off the table and more money you're going to be spending in investment. We know they're already investing more in parks too. And so I think at some point, people just get sick of the spending when you have potential levers to pull to bring revenue in a quicker standpoint and also bring profits in a more near-term perspective.
Yeah, I mean, how do you differentiate Disney Plus with Hulu? How are they totally different? Are they the same? Why have both? I think you're right about the parks. Like, that's where it's sort of the action's at right now, right?
And they didn't say revenue for that either. They just said we're going to spend a ton more on the parks. We don't know what the return's going to look like. I mean, shares.
Well, they know. I'm sure they have plans.
I'm sure.
They just didn't tell us the plans.
They just didn't tell us the plans, but that contributed to the stock price falling pretty significantly. Now, Bob Iger, he has made a lot of cost cuts, laid off 7,000 people. He said he wants to sell off the linear assets.
7,000 people.
Yeah, 7,000 folks. Out of a job.
Not enough for Nelson Peltz, apparently.
Apparently not enough, but to the point of the linear asset sale, potential sale of the linear assets, we did get an interesting note from Needham analyst Laura Martin, who said that she believes the NFL should buy ABC from Disney. And it's a very interesting take when you think about the future of media. It feels like, which we always talk about, we're at this inflection point of where does media go from here, especially within this streaming environment. I'm not sure if that's the best deal, though.
So we've just been talking about Disney stock and why it's at a 9-year low for the last 3 minutes. And a lot of what we've been talking about is costs, right? And the costs that it takes to operate a streaming service. If I'm the NFL, why would I ever want to take on that cost? Right now, I have a tech company that pays me $1 billion a year to broadcast less than 16 games. You have another tech company that pays you $2 billion a year to broadcast your NFL Sunday ticket package. You're giving teams about between $300 to $400 million annually. All 32 teams get $300 to $400 million, I forget what the exact number is, just off media rights. The owners would have to vote for this. It makes no sense if I'm an individual owner, one owner, why I would want to own ABC.
So I get the diversification argument that Laura Martin made, like, you're going into distribution, but like you're hinting at, why would I want to own the actual arm that pays me money to distribute my content when now I have to go into the distribution game and then start selling ads against stuff? Why not just have, the Amazons of the world, the Apples of the world, whoever bidding on that in 2032, right, when that deal comes up? I think that's interesting that she mentioned that, and she mentioned that only Amazon will be the only sole player out there bidding on these services. That sort of boggles the mind. I think the broadcaster will still be around in 2032 if people will be bidding on those NFL rights. I don't see why you want to operate a distribution network at this point. I could be wrong.
Yeah, I don't know. I think that's the big question, and a lot of the tech giants have been the names that have been floated around when we talk about these sports rights because they have the cash to back it up.
Also interesting to hear her sort of say Apple might not be interested in the NFL because they're not international enough. It'll be interesting to see how that plays out when you think about sports media as a whole and if Apple wants to get involved. But I do want to move to one other story that we had our eyes on today. Over in Texas, where we know everything is bigger, The real estate problems are also bigger. So a great story in the Wall Street Journal today highlighting some different stats from Moody's Analytics, essentially saying that Texas has more vacancies, more office vacancies on average than a lot of other major cities. So if you take a look there, that's Austin's office vacancy at 24.2% in the most recent quarter. That's up from about 13% in 2019. The Texas numbers are also about double what we saw in New York City. New York City's at about 12%, and Texas is about double that. And then when you take a look at San Francisco, that came in at about 17%. So you're seeing this bigger problem in Texas. Interesting, the Journal article also highlights it's not really because of remote work. It's more because of a glut of inventory. There's just too many buildings in these places. They overbuilt, and now you combine that with remote work, and you have pretty serious problems.
So much land, easy to build, cheaper to build. They built so much office space there. They talk about in the story about how certain big complexes have been written down. Some of the banks have foreclosed on some of these big properties. It's a big problem. But I was sort of surprised to see that Austin number, 26% or so. I looked up the stats. Austin grew by 33% in the last decade, from 2010 to 2020, right? So they grew tremendously, but for some reason, I guess, there's even more office space that can accommodate the sheer number of people. I heard a stat that was like 1,000 people move there every week, something crazy like that.
My brother just moved there about a year ago, and he goes in the office 3 days a week, remote twice. When I first read this story, I said, okay, that makes sense, because startups, tech life, I'm sure you are working remote more, whereas if you think about New York City with the banking, like JPM, Goldman Sachs, they were very heavy into the return to office mandates. So at first that made sense, but then to read that it was just an overproduction problem was really interesting to me. And I guess you have a lot of land, so why not build? But
and then what do you do with all office space? Like, can you convert it? Can you repurpose it?
Can you make it apartments?
Yeah.
One of the broader takeaways I had there too is just when you have all these people moving to the city and you think that maybe that's the new metropolitan city, right? Like in Austin. What does that mean for restaurants like a Chipotle, Sweetgreen, Cava? What happens to those places where people eat here in cities like New York that are very business heavy? If the new city, people aren't working downtown.
Yeah, no, it's all questions to talk about.
Relax.
Barbecue in Texas.
All right, we'll do a group trip to Texas to really test this out ourselves. But stay tuned. We have more Yahoo Finance coming on the other side of this break. We'll be right back. It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The death toll rising in the aftermath of the war between Israel and Hamas, including Americans. The White House saying now at least 11 Americans have been killed in the attack.
In a statement, President Biden also saying it is likely that American citizens are being held hostage by Hamas. Meantime, Claudia Goldin winning the Nobel Prize in Economics. She's a Harvard professor who was also the first woman to be offered tenure in the university's economics department. Goldin's research is focused on women in the workforce and the gender pay gap. It showed the evolution of female employment over the course of 200 years, especially the rise of working women in the 1900s when the economy shifted to become more service-centric. And tonight, another Powerball drawing. There was no winner in Saturday's drawing, and the jackpot is now up to $1.55 billion. That is the third largest Powerball jackpot in history. The cash payout, nearly $700 million. The drawing is tonight at 10:59 p.m. Eastern.
And time now for What to Watch Tuesday. PepsiCo gearing up to report its latest quarterly results. The soft drink company to release its earnings before the bell. Investors to get a read on the consumer staple amid inflationary pressures. Wall Street expecting revenue here of roughly $23.4 billion and earnings per share of $2.16. Meanwhile, on the legal front, a big day in store for the trial of FTX founder Sam Bankman-Fried. Former Alameda Research CEO and his former girlfriend, Carolyn Ellison, set to testify. Ellison to take the stand and expected to provide insight to the inner workings of FTX and Alameda Research. And lastly, be sure to tune in to Yahoo Finance's week-long special EVs. The road ahead on Tuesday will be breaking down all you need to know for investing in electric vehicles. You won't want to miss it.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow. We will be here 3 to 5 p.m. Eastern for all of the coverage leading up to and then after the closing bell. Have a good night, everybody.